How do I leave my house behind and make sure that my kids don't have to pay taxes for it? Generally, in estate planning, there's a lot of layers of consideration that we're trying to plan for. It is a totality of the circumstances type of proposition. We're trying to create and implement a strategy that makes sure that everything that you want to happen will happen, and that we eliminate or substantially reduce the likelihood of things not happening that you don't want to happen, right? When we pass real estate on to our relatives, to our heirs, our kids, whoever that should be, through our death, through inheritance, those beneficiaries will get what's called a step up in cost basis. The cost basis is the price at which you bought the asset. The step up in basis is what happens when we pass away. It gets adjusted to whatever the fair market value is on your date of death. So if you bought a house for $200,000 and by the time you passed away, it was worth $500,000, your beneficiaries have a cost basis of $500,000. The cost basis is how we calculate tax, and you pay tax on the difference between the basis and the sale price. That's what we call profit. When you pass away and give the entirety of your interest in property to your kids, they receive an adjustment of basis for the entirety of that home. If they receive it for $500,000, their cost basis is $500,000. If they're able to turn around and sell it for $500,000, then they've realized no gain from a federal tax perspective. So they don't have to pay taxes for the money that they're receiving for selling. That only happens when we give the entirety of the equity interest from ourselves to our kids at our death. If we add kids to our deed during our lifetime, they're not going to get a full step up in basis, and they will likely be responsible for substantial taxes.